Investing in the stock market can be a roller coaster ride. Sometimes you win, sometimes you lose. But did you know you can use those stock losses to your advantage come tax time? The IRS allows you to deduct capital losses, reducing your tax bill. When you sell a stock for less than you paid, that's a capital loss. Use these losses to offset any capital gains. This can reduce your tax liability if you had a good year. You can deduct up to $3,000 in capital losses from your ordinary income each year. So if you're facing some capital losses, don't despair. The stock market is like a seesaw, with gains and losses constantly shifting the balance. The IRS lets you use your losses to offset your gains, making tax time less taxing. Sell stocks for a profit of $10,000, but you also sold some at a loss of $4,000. Use the loss to offset the gain. Pay taxes on a net gain of $6,000. This balancing act can reduce your tax burden. It applies to both short-term and long-term gains. Every bit helps when saving on taxes. So you've offset your capital gains with your capital losses, but you still have some losses left over. Don't worry, the IRS has you covered. You can actually deduct those leftover losses from your regular income up to $3,000 per year. That's right. Even if you didn't have any capital gains to offset, you can still use those capital losses to reduce your overall tax bill. This can be a huge help if you had a tough year in the market and need some tax relief. Let's say your ordinary income is $50,000 and you have $5,000 in leftover capital losses. You can use $3,000 of those losses to reduce your taxable income to $47,000. This can lead to significant tax savings, especially if you're in a high tax bracket. Now, what happens to the remaining $2,000 in losses? Don't worry, you haven't lost them. You can carry them forward to future years indefinitely, using them to offset future capital gains or deducting them from your ordinary income, $3,000 at a time. Okay, so you know you can deduct those stock losses, but how do you actually do it? Don't worry, it's not as complicated as you might think. You'll need to fill out a couple of forms. Form 8949 and Schedule D. Form 8949 is where you'll report all your capital gains and losses throughout the year. It's basically a detailed record of all your stock sales, including the purchase date, sale date, proceeds, and any adjustments. Once you've completed Form 8949, you'll transfer the totals to Schedule D. This form is where you'll calculate your net capital gain or loss for the year. It's also where you'll figure out how much of your losses you can deduct against your ordinary income, up to that $3,000 limit. Don't let the forms intimidate you. They might seem a bit daunting at first, but they're actually pretty straightforward. Plus, there are plenty of resources available online and from the IRS to help you through the process. Section 5. Worthless stock? Dealing with bankruptcies. Sometimes, unfortunately, companies go bankrupt. If you own stock in a company that goes belly up, those shares become essentially worthless. The good news is, you can still claim a capital loss on your taxes for those worthless stocks. The key here is to treat the worthless stock as if you sold it on the last day of the tax year for $0. This establishes a sale date and allows you to claim the loss on your taxes. You'll follow the same process as with other stock sales, reporting the loss on Form 8949 and carrying it over to Schedule D. Be sure to keep detailed records, including documentation from the company or a reliable news source, confirming the bankruptcy and worthlessness of the stock. Dealing with worthless stock can be a bit more complicated than a regular stock sale, so it's always a good idea to consult with a tax professional if you have any questions or need guidance. They can help ensure you're claiming the loss correctly and maximizing your tax benefits. Section 6. Smart strategies for tax-efficient loss deductions. Timing is everything, especially when it comes to taxes. While you can't predict the market, you can strategize when to buy and sell stocks to make the most of your tax situation. This is where tax loss harvesting comes into play. Tax loss harvesting involves selling losing investments to offset capital gains realized from winning investments. By strategically realizing losses, you can reduce your tax liability for the year. For example, if you have a stock that has lost value, but you believe in its long-term potential, you might consider selling it to realize the loss and then buying it back after the 30-day wash sale period. This allows you to claim the tax benefit of the loss while maintaining your position in the investment. However, it's important to note that the wash sale rule prevents you from claiming a loss if you buy back the same or a substantially identical security within 30 days before or after the sale. Section 7. The wash sale rule. Don't get caught out. While tax loss harvesting can be a powerful tool, there's one important rule you need to be aware of: the wash sale rule. This rule is designed to prevent people from artificially creating losses just to lower their tax bill. The wash sale rule states that if you sell a security at a loss and then buy back the same or a substantially identical security within 30 days before or after the sale, you can't claim the loss on your taxes. This means you can't just sell a stock on December 28th to claim a loss on your taxes and then buy it back on January 5th. The IRS is wise to that trick. The wash sale rule might seem complicated, but it's really just about preventing people from gaming the system. If you're considering tax loss harvesting, make sure you understand the wash sale rule to avoid any unexpected surprises come tax time. Section 8. Record keeping and seeking expert advice. Navigating the world of stock losses and tax deductions can feel like venturing into a dense financial forest. But don't worry, you don't have to go it alone. Keep meticulous records of all your transactions, including purchase dates, sale dates, and any expenses related to your investments. This will make your life much easier when it comes time to file your taxes. Remember, knowledge is power, especially when it comes to your finances. If you're unsure about any aspect of deducting stock losses, don't hesitate to consult a qualified tax professional. They can provide personalized advice based on your specific financial situation and help you develop a tax-efficient strategy. Tax laws are complex and constantly changing, so it's always wise to have a trusted advisor in your corner. They can keep you informed about any updates or changes that might affect your deductions and help you stay on the right side of the IRS.